Welcome back to Global Mantra. We're still in conversation with Sanjeev Shah of Fidelity International. Sanjeev, we were talking about the European markets and the recovery process. How are you identifying opportunities in this market environment?
Okay, I mean, just my style is very much the same as it's always been, which is a focus on contrarian value stocks. Contrarian, I tend to look for ideas in very unfashionable, unloved areas. Value, because I look for distinct valuation anomalies across the market, stocks which are significantly misvalued. Where am I finding those opportunities today? I think the financial crisis has thrown up opportunities in the financial space. So I'm overweight areas like retail banking in certain geographies, as well as, for example, financial services and insurance as well. The other area that I think has got good opportunities today is in the healthcare space and the pharmaceutical space, which is an area which is very much unloved by investors.
Okay, what about just a holistic view of where Europe stands as of now? There's obviously the debt problem that's having its impact. Do you think by the end of 2011 things will be a lot better for Europe in terms of some of these countries getting bailed out? And what would that mean for the deficit situation for developed or better off European economies such as Germany and France?
Yeah, I mean, I think it's a difficult question. I think we'll have more visibility by the end of the year. However, I think in terms of the economic process, I think this is a multi-year fix as opposed to a short-term fix. At the moment in Europe, I think we have, what is a two-speed Europe. So the countries, for example, in Northern Europe, including Germany, are growing exceptionally fast. That's been driven largely by the export sector and also through a very strong domestic sector driven by what is a very sort of lax monetary policy. And I think that will continue to drive the overall dynamic within Europe. However, we also have the peripheral economies of Portugal, Italy, for example, Greece and Ireland, which are actually, under a lot of pressure, largely because of their leverage in terms of their private sector leverage, in terms of the public sector leverage, in terms of the deficits, etc. And I think, for example, to make the changes there is going to take several years. And I think that's going to require reduction in sort of fiscal deficits and also restructuring of labour markets, deregulatory regimes and things like that.
The ECB has already started talking about rate hikes. You think that's being factored in the market, given the fact that you're looking at evaluating opportunities in the financial space?
Yeah, no, it's an interesting question, the rate hikes by the ECB. I am of a belief that rates will remain lower for longer by the ECB. I think the situation in the peripheral geographies is so tough that actually for the ECB to be raising rates strongly at this point in time would really lead to an increase in the risk for the crisis as a whole, for the Eurozone as a whole. So I think, I've got a different view to the consensus, which will that the rates will remain lower for longer in Europe.
And longer would mean multi-year time horizon?
Probably a 12-month time horizon.
All right. There's also been that announcement of a 500 billion euro fund. Do you think that'll fix the crisis pretty much?
No, I don't think that is something that's going to fix the crisis. I mean, the fund is essentially to help out on liquidity. The sort of sentiment on Europe and the risks surrounding the euro had got so intense that actually having this fund in place certainly started to shift sentiment slightly, but also ease some of the liquidity concerns. However, it doesn't address the fundamental issue in Europe of solvency, and I think that's going to require some other steps. I think there's a political will to address these issues, and there's a political will across the board. And so I think issues regarding whether the euro is going to survive in the short term, I think are misplaced. So what are the steps that I think are going to be taken? I think the fund will be expanded first of all, which will give some additional funding. I think the ECB will continue to maintain a monetary policy which remains fairly loose in the shorter term and will continue to buy back, for example, sovereign debts of some of the peripheral geographies and things. I think longer term, I think we're going to have to see a move towards fiscal harmonization and also the introduction of, for example, common Eurozone bonds. But I think that's something that will take sort of political sort of will, and I think that's a longer term sort of aspect of the crisis.
The other big risk to global portfolios is what's happening in Libya right now. Even for your portfolio, I mean, how does one look at the crisis to kind of de-risk their portfolio from any kind of exposure that they might have, or the ramifications or the fallout of this crisis?
Okay, it's something that I've been clearly monitoring, over time, and certainly since the whole Middle Eastern crisis, including Libya, Tunisia, etc., started to sort of evolve. Trying to get some perspective on what implications it has for my portfolio, and I suppose one of the key macro variables, clearly the oil price, etc. What my view is in the shorter term is actually that the spike that we've seen in oil prices will actually come down and reverse, because what we're seeing is that the Saudis, for example, are starting to increase the supply of oil to offset any sort of restriction in supply that we've seen as a result of the Libyan crisis and things. So I continue to maintain my sort of underweight in the oil exposed sort of stock. I think the large increase in prices that we've seen in the shorter term has been largely driven by speculation as opposed to fundamentally driven by demand and supply. On a slightly different note, as I've indicated at the start of the program, that my view is that we're at the latter ends of the rally in equity markets since early 2009, which have risen by 60%. And if I'm looking to protect my portfolio going forward, I have got the ability to, for example, to buy put options on the index. I've also got the option to short stock and also increase my cash exposure within the fund as well, to protect the portfolio.
Okay, so in terms of specific opportunities, are you reducing your exposure to energy companies? Because that's one philosophy of investment that's doing the rounds, with crude expected to move up. What's the position of energy companies?
Okay, I mean, energy and commodities in general, I'm very underweight this area. I'm quite negative on the whole commodity landscape. I think these were the leaders in the market in the last bull market.
All right, so we'll take a break on that note, but when we come back, discuss more specific opportunities, the individual stocks and sectors that Sanjeev is bullish on, and the outlook from a near-term perspective.
Unlike a lot of other fund managers, I'm very negative on the whole commodity space. So that includes, for example, Vedanta. I continue to be bullish on equities longer term because I think corporate balance sheets are in a lot better a position than they were historically. I think, things like cash yield and free cash flow yields are still very attractive. So that looks attractive. M&A is starting to pick up as well as financing market opens up, etc. And I think today, growth at a reasonable price is very cheaply valued by the market.